welcome back to the Gold Standard. I'm here with Sasha Reyes, and today's episode is one you'll want to stay with start to finish.
Good to be here, Marcus Blackwell. Big day in the markets, and we have a lot to work through.
We do. Gold is moving higher today, and the driver is a story that connects geopolitics, oil prices, and real yields all at once. Bloomberg and Reuters are both flagging U.S. Iran deal prospects as the catalyst, with the dollar softening and inflation fears pulling back.
The important thing to understand is whether this is a real shift or just a headline pop. We'll stress test that in the first segment.
Then we get into central banks. Goldman Sachs has revised its gold demand forecast upward for 2026, and the data behind that revision tells a deeper story about reserve managers moving away from treasuries.
De-dollarization is the word people keep using, but the numbers are what matter. We'll ground that conversation in actual sovereign buyer data.
And we close with the mining sector. Agnico Eagle just approved the Hope mine in Nunavut. Perpetua Resources landed a $2.9 billion EXIM loan for the Stibnite project in Idaho. Record Q1 profits for miners, but Q2 is shaping up to be a cost squeeze story.
Fuel costs are up sharply, and whether miner equities hold their leverage advantage over bullion is a real question worth asking.
A lot of ground to cover. Let's get into the first segment. Gold is up. Right now, according to Bloomberg and Reuters, prices are rising on a weaker dollar and falling oil as markets digest the prospect of a U.S. Iran deal that could reopen the Strait of Hormuz. That's the headline. Let's get to what it actually means.
And to be clear, this isn't a small move. The WSJ is reporting gold and silver both gaining today on those Iran deal hopes. The question is whether this is a genuine repricing or a geopolitical pop that fades by Friday.
Here's the mechanics. A potential Iran deal reduces the risk premium baked into oil. Lower oil prices means softer inflation expectations. And when inflation expectations ease, real yields don't spike as hard. Here's why this matters to gold. Every basis point higher in real yields is a headwind for bullion. So a deal that keeps oil in check is actually a gift to gold through the yield channel, not just sentiment.
Right, and that's the transmission mechanism most people miss entirely. They see Iran deal and think pure geopolitics, but the actual path runs through oil, then into inflation expectations, then into real yields, and finally into gold prices.
Exactly. The dollar weakening on this news compounds that. Gold is priced in dollars, so a softer dollar is a direct tailwind, two forces moving in the same direction at once.
So let's apply some structure here. I keep coming back to three variables when reading moves like this. Where is inflation actually headed? How long do yields stay elevated? And what signals is the Fed giving? On all three right now, the Iran deal news is tilting dovish, at least in the near term.
Walk me through that.
Sure. If oil comes down because Hormuz reopens, the next CPI print looks better. That gives the Fed less urgency to hold rates higher. And if rate hold expectations ease even slightly, gold catches a bid. The data flow from this one geopolitical event threads through every variable in that framework.
But here's the tension. This is a hopes for a deal story, not a deal. Bloomberg's framing is careful. Signs the U.S. and Iran are closing in. That's not signed and sealed.
Which makes the sustainability question real. If talks break down, you reverse all of that in a single session. Oil spikes back, inflation fears return, dollar firms up, gold gives back the gain.
So what does that tell us about how to read this move?
It tells us the structural case for gold can't rest on this catalyst. The geopolitical pop is real, but temporary. What you want to know is what's underneath it when the headline fades.
And that's the more interesting question, because even without Iran, gold has been moving. Central bank demand, dollar skepticism, debt concerns. The Hormuz story accelerated a move that already had momentum.
The Bloomberg piece frames it well. Iran deal prospects tempered inflation concerns. That's the market's read. But the important thing to understand is what the gold market was already pricing in before this week.
To put this in perspective, a ceasefire premium in gold is measurable and tends to be short-lived. We saw it during the early Hormuz tension spikes earlier this year. The initial move is sharp, then the market settles back to asking what the underlying demand picture looks like.
Right, and that underlying demand picture is where the real story is. Not the day-to-day geopolitical noise, but the structural buying happening quarter after quarter.
Which brings us to a question that's harder to answer from headlines alone. If you strip out the Iran news today, who is still buying gold? Why and by what scale? Because if the structural floor is strong enough, the geopolitical pop is just a bonus on top of an already bullish setup.
And Goldman Sachs, for one, has a pretty direct answer to that question. Their revised figures on who's actually building gold reserves right now point to something the headlines won't capture: structural demand that doesn't hinge on any single geopolitical event.
So the question isn't just what moved gold today. The question is what keeps it there. And the answer might have very little to do with Iran. And that structural demand question is exactly where Goldman Sachs comes in. They revised their central bank gold demand forecasts upward this week, and the numbers are significant. Purchases are expected to accelerate through the rest of 2026, not slow down.
Right, so the baseline expectation was already elevated, and Goldman Sachs is now saying even that was too conservative. Kitco covered this Tuesday, and the framing was clear. Sovereign buyers are adding gold faster than models predicted.
The important thing to understand is the scale here. This isn't one or two central banks making tactical adjustments. According to Goldman, as reported by Banking Exchange, it's a broad-based accumulation trend across emerging market reserve managers, and it's tied directly to how they think about dollar exposure.
Here's why this matters. For decades, the dollar was the reserve asset. You held treasuries because they were liquid, safe, and returned something. But what happens when you start questioning the long-term credibility of the issuer?
You look for alternatives. And gold is the one asset that doesn't come with a counterparty. No issuer, no credit risk, no political leverage over your reserves. The U.S. Gold Bureau published a piece Thursday on this de-dollarization wave, framing 2026 as a structural acceleration, not just a blip.
And that framing matters. The ETF database piece from Friday made a point worth anchoring. Gold has now overtaken the dollar in share of global reserves tracked by certain metrics. That's not a headline from 10 years ago. That's now. So when you ask which central banks, the answer is broad. China's been steady. Poland and India added significantly last year. Czechia, Hungary. These aren't fringe players building emergency stashes. These are sophisticated reserve managers making long-duration asset allocation decisions.
To put this in perspective, reserve managers think in 10 and 20-year windows. When they rotate out of treasuries, they're not reacting to a bad inflation print. They're making a statement about the system.
And the Seeking Alpha piece from Monday, citing Goldman directly, put a fine point on it. Central bank demand has been stronger than previously estimated and is likely to pick up again, with prices expected to recover by year-end, partly on that basis.
So here's the question that keeps coming up in this data. Is gold being repriced structurally, or is this still a cyclical trade? Because those are very different answers for an investor.
A cyclical trade says buy the dip, ride the headline, take profits when the narrative shifts. A structural repricing says the floor is moving. The baseline value assigned to gold by the largest buyers in the world is going up, and it may not come back down.
And central bank buying at this pace is exactly the kind of demand that supports a floor, not a ceiling. These aren't momentum traders. They don't panic sell on a weak jobs number.
Right.
They accumulate and hold, sometimes for decades.
Which is why the Goldman revision matters beyond just the forecast. It's confirmation that the buyers with the longest time horizons are getting more aggressive, not pulling back.
And that connects directly to something we need to work through in the next segment. Bank of America put a $6,000 price target on gold, and on the surface, that sounds like an aggressive bull call. But the gold-silver analysis from Thursday frames it differently. That target isn't really a price prediction.
It's a system call.
Exactly. It's a judgment about U.S. debt, dollar credibility, and whether gold is being permanently revalued within the global financial system. 5 major institutions now flagging the same repricing thesis. That's worth unpacking carefully. So Bank of America put a $6,000 gold target out there. Gold-silver covered this in detail, and the framing matters. They're calling it a system call, not a price call.
meaning the number itself is almost secondary.
Exactly. The argument is that U.S. debt dynamics and dollar credibility are deteriorating structurally. If you believe that story, $6,000 follows. If you don't, the number sounds absurd.
And Gold Silver noted 5 major institutions are now flagging some form of gold repricing, not just BOA. That's what makes this interesting to me.
What do they agree on?
The broad thesis, gold is getting a new floor, not just a cyclical bounce. Where they split is timing and magnitude. Some see 5,000 by year-end. ING had that target out through index box coverage earlier this week. BOA is farther out on the risk curve.
Here's why this matters. A price forecast from one bank is noise. 5 institutions converging on the same structural argument is a different kind of signal.
Right, and the argument isn't complicated. U.S. debt is at $40 trillion and climbing. If foreign holders decide treasuries carry more risk than they used to, they need somewhere to put reserves. Gold is the obvious answer.
Which connects directly to what we walked through in the last segment with central bank buying. The sovereign accumulation and the institutional repricing thesis are pointing at the same thing from 2 different directions.
And here's the counter-argument worth hearing. If the Iran deal goes through and oil stabilizes, inflation pressures ease, real yields firm up, and suddenly gold's overhead looks heavy.
So the system call only works if the macro deterioration continues. It's not self-executing.
Correct. The 6,000 case needs the dollar credibility story to keep unfolding. That's not guaranteed.
Fair. Now, if listeners are sitting with all this macro conviction and wondering what to actually do with it, there's a practical angle worth landing on.
The ETF fee question.
Yes, 24/7 Wall Street ran the math on this recently. Most gold ETFs, GLD, PHYS, are charging around 0.40% annually. That's the standard.
Sounds small.
Over a decade of compounding gold prices, that drag adds up to a real number. The piece pointed out one ETF charges roughly a quarter of that. The difference over time is material.
So if you're building a long position based on a structural repricing thesis, not a trade you're flipping in 6 months, fee drag matters more than most people calculate.
The important thing to understand is that the macro argument and the implementation decision are separate problems. You can be right about the thesis and still lose ground to fees over a 10-year hold.
2 things worth doing. Check the expense ratio and understand whether you're holding a closed-end trust or an open-ended ETF, because the structure affects how closely price tracks the underlying metal.
The important thing to understand is that the macro argument and the implementation decision are separate problems. You could be right about the thesis and still lose ground to fees over a 10-year hold.
2 things worth doing. Check the expense ratio and understand whether you're holding a closed-end trust or an open-ended ETF, because the structure affects how closely price tracks the underlying metal.
The bull case for gold is well supported right now. Multiple institutions, central bank flows, geopolitical pressure on the dollar, but conviction doesn't exempt anyone from doing the implementation work.
And speaking of implementation, that conviction has to be matched by the companies actually pulling gold out of the ground, because the macro setup only pays off if the mining sector can deliver.
Which is exactly where we're going. Major capital commitments, record earnings running into a Q2 margin squeeze, and some exploration results that are hard to ignore. Mining is where the rubber meets the road. Shifting gears to mining, and here's where the bull thesis either gets confirmed or complicated by real capital decisions.
Right, and 2 announcements this week make that concrete. Agnico Eagle approved the Hope Bay mine in Nunavut, reporting a potential output of over 400,000 ounces per year. Then Perpetua Resources landed a $2.9 billion Exim loan for the Stibnite Gold Project in Idaho.
That's federal financing, fully funding construction capital. These aren't exploration bets. These are decade-long commitments.
Which tracks exactly with what we've seen in consolidation. When senior producers are flush with cash and sovereign buyers are stacking reserves, junior projects suddenly look fundable. The capital cycle confirms the conviction.
And the Q1 numbers back that up. Gold miners posted record profits to start 2026. Record. But here's the part that matters for equity investors watching this space.
The Q2 squeeze.
Exactly. Crux Investor reported this week that fuel costs are up 50 to 100% in some operations. Open pit mines, Australian producers especially, are most exposed. So the question for anyone holding miner equities is, does gold price leverage survive that cost compression?
And the honest answer is it depends on the operation. Underground mines with lower haulage exposure are better positioned than large open pit operations. The spread between winners and losers in Q2 could be significant.
To put this in perspective, miners ran hot in Q1 because gold prices were elevated and cost structures hadn't fully repriced to higher fuel. Q2 is where the math gets harder.
There's also a quick read from Mining Weekly today worth flagging. Cygnus Metals hit high-grade intercepts at their Chibougamau project in Quebec. We're talking 8.4 meters grading 16.3 grams per ton.
Wow.
Junior exploration is heating up when senior balance sheets are this strong.
That's the flywheel. Senior cash flows fund exploration premiums and juniors get financed. It's a healthy sign for the sector overall.
So the forward-looking question for investors is clear. Bullion gives you clean exposure to the macro thesis. Miners give you leverage, but Q2 cost pressure means that leverage cuts both ways. The miner versus bullion calculus is worth watching closely through the next earnings cycle.
Right. And whether Agnico and Perpetua's long-cycle bets pay off will tell us a lot about whether this capital commitment reflects genuine structural conviction or just peak cycle optimism.
The numbers will answer that. Watch QT margins.
That's a wrap on today's episode. The thread that runs through everything we covered comes down to one idea: short-term noise versus long-term conviction.
Right, and the Iran catalyst was a perfect test case, a hopes for a deal story moving markets in real time.
And Goldman's central bank demand revision sitting underneath it all. When reserve managers rotate out of treasuries, that's not a tactical tweak. That's a statement about the system.
So wherever you land on the near-term price action, the structural case for gold keeps building.
That's the takeaway. Watch the fundamentals, not just the headlines.
Warmingly, if this episode brought you value, subscribe and leave us a review. It genuinely helps. And questions, reach us at goldstandard@heymato.com.
Thanks for being here. We'll see you next time on The Gold Standard.
Stay sharp out there.